Today, Bitcoin hits a bear note, so where next? Hello again, it's Martin North from Digital Finance Analytics. Well, notice posts covering finance and property news. Volatility in crypto has pulled the value of Bitcoin towards $80,000 US as the so-called Trump bump continues to fade across the markets. With a pro-growth president devoted to deregulation and bent on asserting US dominance over everyone else, the conventional wisdom was to pile into US assets and crypto and brace for bond yields and the dollar to surge higher. All that happened in the weeks after the election, but since Donald Trump actually took office on January the 20th, and particularly in the last week, all the Trump trades have reversed. As Bloomberg reported, the latest Conference Board survey of consumer sentiment published on Tuesday, and by the way, the first since Trump took office, it dropped sharply. His first-term expectations rose immediately. This time, even though his arrival in office has been accompanied by far more excitement and action than he generated in the first, it seems consumers are more dubious. The Conference Board doesn't break down its respondents by political identification. We can assume that Democrats are far more bearish about increasing inflation than Republicans. However, the median could not have risen so much without a significant cohort of independents and Republicans adjusting their views higher, presumably because of fears of what tariffs will do to prices. Actually, there's a name for a growth scare combined with rising inflation expectations. If it looks like a duck, swims like a duck, and quacks like a duck, then it's probably a duck, comments Vincent Dillard of StoneX Financial. Similarly, if growth slows, inflation accelerates, gold soars, and the dollar rolls over, then it's probably stagflation. Bitcoin, of course, is a bellwether, and it extended its losing streak for a fourth day on Thursday, remaining near its 3-month lows as ongoing uncertainty over US tariffs continues to weigh on risk-sensitive assets. The world's largest cryptocurrency fell 2.8% to 86,142 US and remains near its lowest level since middle of November 2024. The token fell to as low as $82,332 in the previous session. According to CoinGecko, the global cryptocurrency market cap today is $2.97 trillion, down 4% in the last 24 hours, and a 31.3% change compared to 1 year ago. As of today, the market capitalization of Bitcoin is $1.7 trillion, representing a Bitcoin dominance of 57.58%. Meanwhile, stablecoins market caps is at $231 billion and has a 7.82% share of the total crypto market cap. Now, there are several factors driving Bitcoin's roughly 20% fall from a record high since Donald Trump's January inauguration. This includes Trump's combative stance against allies and geopolitical rivals alike, and that's shaken investor confidence. And there are also rising concerns about elevated inflation and even stagflation. The crypto sector was also shaken by a record hack of the Bybit exchange last week. As a result, we've seen the biggest slump since August, and other tokens such as Ether and Solana also continue to be hit harder, with each down somewhere between 9 and 10% respectively. Indicators suggest further declines are distinctly possible over the coming days. For example, a quick look at Bitcoin options reveals that investors and traders are hedging against a decline in the cryptocurrency to levels last seen just after the election day. The open interest or number of outstanding contracts for put options with a strike price of 70,000 US is the second highest amongst all contracts expiring on February 28th, according to data from Deribit. That's the largest crypto options exchange. A total of $4.9 billion in open interest is set to expire on Friday. And there were liquidations of around $2 billion of bullish bets over the past 3 or 4 days, according to data compiled by CoinGlass. Bitcoin perpetual futures, one of the most common ways for offshore investors to add leverage, saw a sharp drop in long positions during the period. Another indicator is spot ETF withdrawals. The most recent price decline was also due in part to waning demand for Bitcoin exchange-traded funds. As a group, the funds have seen about $2.1 billion in outflows over the past 6 days. This is a mix of spot selling and bias unwind, said Bohang Zhang, head of over-the-counter options trading at Abra. In my view, nearly all of this is from ETF spot outflows from directional traders. And data shows that investors yanked more than $1 billion from spot Bitcoin ETFs on Tuesday. That's the biggest outflow since the cohort debuted in January last year. Fidelity-Wise Origin Bitcoin Fund, ticker FBTC, posted the steepest outflows among those funds, followed by iShares Bitcoin Trust ETF, the IBIT, according to data compiled by Bloomberg. That's as Bitcoin prices have faltered, with investors shunning riskier assets in the face of growing uncertainty. As a group, the Bitcoin funds shed $2.1 billion over the last 6 consecutive days, the longest stretch of outflows since last June. Digital assets are still very retail flow driven, despite institutional flows over the last 12 months, said Jeff Kendrick, global head of digital assets research at Standard Chartered. This sets them apart from equities and fixed income. In my opinion, this means the average hand is weaker or has less deep pockets to ride losses. Hence, more pain is likely. Kendrick predicts Bitcoin will trade even lower at around $80,000 or thereabouts, at which point he said that he would buy the dip. To Matthew Siegel, Van Eyck's head of digital asset research, the record outflows likely stem from hedge funds unwinding a popular trading strategy called the basis trade, which exploits differences in prices between spot and futures markets. Some have used the ETFs to profit from the cryptocurrency's volatility or offset a short position in derivatives. This strategy involves buying Bitcoin spot, often through ETFs, while simultaneously shorting Bitcoin futures to lock in a low-risk return, Siegel said. However, the profits from this trade have recently collapsed, making it far less attractive. As a result, hedge funds that were using ETFs for this strategy have likely closed their positions, leading to significant redemptions. It's also possible that investors newer to the crypto arena, who are generally considered more likely to panic, have driven the outflows. That's according to Stefan Ockwell, Chief Executive Officer and founder of FRNT Financial. Those investors are less indoctrinated into the space simply due to the fact that they do not have their own infrastructure to hold physical Bitcoin. He said, I think it's too strong to characterize ETF outflows as investors not buying the dip in Bitcoin. Now, it's quite likely we will continue to see extreme volatility in the sector, and the journey up and to the right quite possibly will continue given the limited supply of Bitcoin. So while as a speculative trading asset, people will continue to play with it, as a cornerstone of a secure wealth building strategy, I'm less convinced. More broadly, markets are trying to assess the uncertainty from the impact of Donald Trump's policies on an already strained economic situation. His policies are expected to sustain higher than wanted inflation due to tariffs and increased domestic demand, likely keeping the FOMC from lowering interest rates. The question is inflation going to hold steady at its current levels or accelerate as it did in the second half of 2024? If inflation does continue to accelerate, the FOMC must raise interest rates to combat inflation, which could easily tip the economy into a recession. Trump's policies also include massive layoffs. The Department of Government Efficiency, DOGE, is cutting government jobs by the thousands and will impact the labour market generally. That's bad news for employment data and the consumer outlook, but it may have a silver lining. Reducing government jobs may offset Trump's inflationary pressure enough to keep it from accelerating consumer-level inflation, so perhaps the rate hikes are less likely. My point here is that market uncertainty is broader than just crypto, but Bitcoin and other coins are likely to continue to magnify the volatility also visible in other markets. So no wonder perhaps that a critical detail from the 2025 meeting is that Warren Buffett's Berkshire Hathaway's cash pile hit a record high of over $330 billion, suggesting the Oracle of Omaha and his investment colossus are on the sidelines. So all up, hang on to your hats. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.